Today's conversation is for educational and informational purposes only. Our guests' insights are based on their professional experience and do not constitute legal, tax, or investment advice. Because everyone's financial situation is unique, please consult with your own licensed advisors before making any investment decisions.
So when I discovered passive income, I thought, well, wow, I can actually get people that are doing this for their full time job. For me, it wasn't a full time job. Mine was running my company. So when I finally sold, that was the next path because I sold for specific emotional reasons. I had young children. I
Mm.
was burnt out. And you start to think about if I, yes, I can go do all these real estate acquisitions myself, but a couple of things happen. A, you run out of money, personal money to keep putting down payments on these properties. And secondly, it's difficult to scale. So that's why there's a power in partnerships and letting people get involved that do this for a living and they can concentrate on it all day long so that you as the investor don't have to.
Hi, everyone, and welcome back to Your Customer, Your Success. My guest today is Ian Noble, founder of Run Steady Investments. Ian spent 14 years building and operating a 14 location dry cleaning business in Austin, Texas, before exiting in 2023. Since then, he's focused on helping business owners think differently about wealth outside the business through passive real estate investing, with a focus on mobile home parks and private lending. What makes Ian interesting for this show is not just the asset class, it's the operator mindset behind it. He approaches investing the way many strong founders approach business decisions: start with trust, do the vetting, understand the people running the deal, and stay focused on steady, disciplined growth rather than chasing excitement. Ian, this is going to be an interesting one. Welcome to the show.
Thanks for having me, Gary.
Hey, it's I think I've lost count of how many Austin, Texas people have had on the show. So I wanted to say it's nice to talk to somebody from Austin, Texas, but you're probably guessed 6 or 7 out of the last 10. I don't know what it is. Do you guys hang out and like figure out how to get on podcasts down there?
We're a popular place here, but I'll tell you, I'm born and raised, so I'm one of the few that's been here my whole life. Good place to be.
It is. I'd love to be there. Like I said, I've only been to Houston. So I'm looking forward to getting back there someday. It has been way too long since I've been in the great state of Texas. So let's get going. This is going to be an interesting one. Everybody who listens to the show knows I have an investment background. I've worked with large investors my whole career. But real estate and alternatives are a little different to most people. So I thought this would be an interesting topic for everyone. But before we get into the real estate business, I just want to do a little quick background. You built and exited, it was 14 locations, a dry cleaning business. How did that experience change the way you think about building wealth outside of a business?
It changed everything after that business ended, and I'll get into that today. I want to first say everything that I tell you and my story is a personal journey. By no means is this investing or tax advice. As you mentioned, or as everyone says, always consult with your legal team, tax advisor, or CPA before making any investment decisions. With that out of the way, let's get to
Yeah,
the fun stuff.
right.
It changed everything. When you get out of business ownership and you get onto the next chapter of your life, you really can look at things through a different perspective for a couple of different reasons. Number one, you've been on both sides of the transaction. Number two, there's traditionally a liquidity event, and hopefully it was good for you. And third, you focus on things that perhaps don't utilize your time as much as your business did. So a lot of what I focus on today is making sure that anything I get involved with, it's not sucking up my time like what like my world as an entrepreneur running a small business.
And and a lot of people now, I would say I don't contemplate real estate as an investment because I'm worried real estate would take up all my time. It's complicated. You've got lawyers, you've got maintenance, you've got the management of it. So tell us what you're doing, because I think a lot of people might miss the difference between what you're doing and purchasing real estate, right?
Yeah, so the key difference in what I do today is people will look at real estate and they either are going to be an active investor or a passive investor. So to define that, an active investor is somebody that is buying property themselves. Perhaps they're managing it. Most often, the path to get into this is buying a single family residential home and renting it out to a tenant. People do this, and it's a great way to create wealth for yourself, but they realize that actively running their real estate portfolio or even dealing with tenants is not ideal. It can be a headache. Not always, but there are. Every landlord out there will tell you some horror stories about being a landlord. So, what I focus on is passive investing. And what we are doing is, as a group, we are going and investing into cash flowing opportunities that I consider low risk with operators that are actively running it to where we are not involved in the day to day of the business. So you're still in the real estate realm, you're still participating as an owner or to whatever capacity that investment looks like, but we're not running the day to day. And therefore, it allows us to remain passive. Our job is to vet the investment, to allocate our capital or put money into this investment vehicle. And then throughout the way, I view it as a partnership. But again, it doesn't take up our time moving forward.
Interesting. So you're taking the approach of a passive investor, and the time savings are a part of the equation, because I think a lot of people do think, like I said, it's a lot of work owning real estate, and the horror stories. Not only from, look, I rented. I have lots of
Yeah.
rental horror stories. I'm still scarred about it, but I wanted to set I wanted to make that clear. Excuse me for the audience, because I just want to make sure everybody was focused on exactly what we're talking about here. So I thought this is an interesting topic because I don't hear this conversation too often. In my line of work, I've heard it a little bit, but most people and entrepreneurs and small businesses might not be thinking in that mindset. So I think what you have here is a situation. A lot of entrepreneurs are great at generating income, but they're not always that intentional about creating income beyond the business. So why do you think that is, and how do you kind of turn that mindset around?
Small business and entrepreneurship is hard and it does require all of your attention. And so I think most people put everything else to the side and focus on their business. And for many reasons, they should. That's going to be how they generate income. That could potentially be an exit for them down the road. But I would urge people to make sure that they're doing something outside of their business, because too often things happen in life where something could go wrong. Your company could be sued. You can drive by any town and see a slew of personal injury lawyer billboards just waiting for your company vehicle to make a mistake. So these are real life scenarios that can happen. And what I stress people to think about is, if that all stopped, you could have a heart attack, anything, where if you're at
Mm.
the center of your business, there needs to be a plan for you to provide income for your family, and to also, during this time, not take up any more time. That's where this industry of passive income is so attractive, because yes, there's a lot of work that goes on behind the scenes. People are incredibly active. That's a misconception that people always ask me, well, how does it work if everyone's passive? And the answer is they're not. We're putting our faith into a team that is actively managing and running this business, and we are leveraging their skills and time to benefit us. So it's a win-win situation, because those teams that are running the day-to-day, they need the investors' help. This is how they take down deals and acquire deals. But for a business owner or someone who is busy with their family, it is a good opportunity to think about what happens when the show stops. And it's
It,
worth a conversation. So
it,
whether it's in real estate or any other capacity, you need to be thinking about this, because what is it, Gary? I think it's the 5 Ds. It's death, disability, divorce. What else we have in there?
I don't know, but
Disaster. We're missing a few, but
those are
you
bad
get the
enough.
picture. Yeah, yeah.
And I didn't think of being, the disability aspect of it. Heavens forbid, you have a heart condition or something, and you can't work for a bit. And I know my father he had his own law practice, and at the end, his heart conditions and things just took a toll. And yeah, so I wasn't even thinking along those lines. So that's an interesting thought. Um, yeah. So tell us more about how somebody's got to do the work in these deals, right? So you've got to vet these people, and I think that's really what you're doing. You said these deals, the operator matters as much, if not more, than the asset you're buying, right? Because there is a lot that goes on behind it, and I think maybe that's kind of the key to this. Is there's the investment, but then who's running the show? Because somebody has to do all that work, right?
Yeah, much like finding staff for your team, the most important thing are the people that are running it. So too often in this industry, people will send out brochures or what we say as pro formas to show you how great this asset will be, whether it's in real estate specifically, whether it be a commercial property or an apartment complex, whatever it is, you're going to get this brochure telling you what they think the returns will be. But they're always incorrect. So they'll be better or worse. And what I've seen is it always comes down to the individual running it, because real estate is a business where you're transacting, you have systems in place. And especially if you're dealing with tenants and turnover, you're advertising, it's just like any other business. And so you need somebody that will be in your corner to make sure that when things get hard, or if there's a cycle that we're having to ride through, that they are the person that's fit for the job. So people are the most important thing. I put a lot of time and energy into finding those good people, because at the end of the day, that's who you're partnering with. When you become a passive investor, think of it like a partnership to where they're doing the work for you, and you need to know, like, trust them and make sure that you're fully comfortable with those people handling your money.
And so I want to get to the relationship aspect of this in a moment, but you said something that piqued my interest. Now, I come from an investment servicing background, and every investment performance summary I've ever put out in a presentation in my life said past performance is not indicative of future results.
Yeah.
So you said something there that they have returns in there, and then they're not. I'm hoping that they say past performance is not indicative of future returns, but that's kind of be interesting. Those returns have to vary wildly. Is there a big um, variance in returns? Is there, you know what I mean? I
Yeah.
could see real estate going up and down a lot, and that could scare people off. I think that's kind of what I'm getting at.
There is, because a lot of it is foresight, and somebody may feel that you're looking at two columns when you look at the success of a deal. So your revenue or income that's coming in, typically through rent, and then your expenses. Where people mess up is often they'll assume that rent increases will continue. So the industry norm used to be 3% a year. Well, I'm in Austin, Texas. We had a terrible loss since I think we just landed back at pre-COVID rents in Austin, Texas.
Really?
A really sharp decline last year.
Mm.
Yeah, because the market looked good and everybody was coming to Texas, and landlords were happy during that time, just like all over the nation, because homes were selling for premiums, people would rent for premiums, and all that went away. So in underwriting, it's crucial to look at these. And what I would suggest to anybody that gets approached by someone who's doing passive income and real estate, a good rule of thumb is you can anticipate a 1% rent growth. I think it's a really safe way to look at it. It doesn't seem too attractive, right? Just 1%.
No.
But I think on the underwriting side, you want to be a little negative and look at this through the lens of, well, that's nice that they projected 3%, but does it work at 1%? And then same thing with expenses. I'd say 3 or 4% per year. So I see a lot of stuff in this industry that, well, we have systems and efficiencies. We're going to reduce their expenses by 20% of the previous operator, but we're going to increase the income by X% a year. And I think that's a great idea and a lofty goal, but it's not realistic.
Mm.
So a lot of what I look for is finding reality through these marketing brochures to see if the person is in fact looking at this from a safety standpoint. I My background was a small business owner. I ran off thin margins and a P&L. So for me, when you see these lofty goals, you know the reality of how
It,
business can be difficult. And so it's
mm.
important to remain grounded. And I am particularly risk adverse. So everything that I look at, and with our group of investors, that's that's the avenue that I am seeking.
It,
So yeah,
so yeah, no, that's great because you're not being overly aggressive, right? Because I think that this type of investment could scare the bejesus out of people if they're worried about those fluctuations and an overvaluation. Because the real estate market is hard to pinpoint, and hard to predict. And like you said, you never know what's going to come on. Like who the hell would have thought COVID would have come along?
that's right.
And so it's really hard to for people who are not in the business to kind of grasp and get a feel for it themselves. I think a lot of people think they know about the stock market and bonds and all that, and that's a little easier. But this is interesting stuff. So, you mentioned something that just gave me a flag, red flags. What are the red flags that tell you an operator may look pretty good on paper, but they might not be someone you want to invest alongside?
The easiest red flag, or where I would start with, is really diving deep into that person and figuring out, are they who they say they are? So you want to look at track record. Sometimes that's not available because real estate has a lot of private deals going on. So the internet has been a helpful tool and place to look for that. There are tools out there like LexisNexis. You can find dirt on operators on Reddit or all sorts of forums. And generally speaking, I'm not going to say that they're all accurate, but if you Google somebody's name and there's the word fraud or Ponzi next to it, and you see that
Mm,
everywhere, then most likely that happened, because if things were going great for all the investors, you wouldn't see that. So I'm looking, number one, at that. And before we work with somebody or present a deal to the network, that person needs to be background checked. I generally have already worked and invested with them before. So I'm really taking my time to vet these operators, because in what I do for a living, and this is raising capital, we're placing money into these deals as passive investors. You get pitched in a lot of different directions by
mm,
people that are looking to acquire or operating these deals. And they're telling you this is the best thing, you're going to make a great return. You have to say no to most of them. You have to identify what you are good at and where your risk tolerance is. But at the end of the day, again, it's a people business, and most of my efforts are concentrated on good people. Now, I mentioned all these steps that I take. It probably curbs my growth as a business because it's a long time to get new partners. Because what do? You invest with somebody first, my own money, and I have to see how the deal goes. And then we wait. And by the time another opportunity comes up, it could be a year down the road.
right.
So it's a slow build relationship game that I enjoy because I get to play investor first.
Hmm.
And my job is to make sure that I'm protecting everyone that comes along with me on the next one, making sure that it's as safe as possible and it has been vetted as much as possible.
That's interesting, and that's why I have you on here, because in the end, so your value is really building relationships, is it not?
That's right. It
And
is.
and I would think most people would not think that that's the case. So how do you present that to your potential investors? The importance of that, because I think everybody's going to be all about the piece of real estate they're buying, right, or the fund they're buying into. I'm not sure exactly how you work the actual real estate investments.
I've learned that it's about the person that even for the investor, often. So I raise capital, and most of my market is in Austin, Texas. When I say market, these are investors that come alongside with me. Well, why is that? Some of these deals that we might take down are in Tennessee or in South Carolina. There are other ways that people can get involved in investing, but often people don't know where to start, and they want somebody in their corner that is involved too. So I think that's the differentiator. It comes down to trust, but also someone that understands this business and that is putting their own skin in the game. So I
Mm,
think that alignment, you run into certain style of investments that are out there, and they could be pitching people to put in, X number of dollars into an investment deal. But what's unique about this business, and not with all people that raise capital, but in our situation with Run Steady Investments, is I'm putting my own money into every one of these deals. So if I go and look you in the eye and say, I think this is a good, viable investment. Oh, by the way, I also have $100,000 of my own money in this. I believe it holds a little bit more weight than me saying, Gary, you should really do this. And then that person sitting back waiting to collect some fee because Gary's going to invest. So it changes the trajectory of the 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 group and the mindset of, wow, we actually are all in this together as a partnership. Is how I look at it.
Yeah. No, and that's interesting, and that's a fascinating aspect of it. Um, uh, so one more time on just, and I know we talked earlier before recording today. What exactly type of real estate are you focused on? Because I don't think we've delved into that too much.
Sure. Yeah, there's two avenues. One of them is private lending, and the other one are mobile home parks. So I focus on those two, and they're different style investment. The
Hmm.
private lending funds, that is my flagship fund. It's open all of the time, and a lot of times people use that as a parking garage for their funds to earn more, especially business owners. If they have too much money sitting in a checking account, or
Mm,
an account that's earning zero, or now with money market accounts, at the time of this recording, let's say they're just shy of 4%. So the private lending fund is a good way for people to park money, get introduced to the game of passive real estate and what it looks like, and then also have liquidity. On the other side of that is mobile home parks. I like to focus on that. There are a lot of different ways you can invest in real estate. Virtually every single asset class, again, shopping centers, apartment complexes, they're all out there to invest in. People sometimes get tied up on what they're familiar with. A lot of people in the space go to apartments just because they've probably
Mm,
rented one at some point in their life. But I like mobile home parks because of the stability, and there's protection in the fact that they're not allowing new mobile home parks to pop up in your area.
mm.
So there's a supply cap, and that's different than most asset classes. If you build an apartment complex down the road and you have all these projections for what your occupancy might be, well, the next year they could build one right next door to you, and that could, create saturation. It could be harder to fill that up. But with mobile home parks, that's not the case. And this is different than RV parks, by the way. RVs, think about it as a trailer that's pulled behind your vehicle, and a truck could hook up to the RV and someone's going to a campground. That's not what we're looking at. These are manufactured houses. They're brought in, they're placed there, and they usually stay there because they're expensive to move. So you might be talking about $10,000 or $14,000 to move one of these manufactured homes away from where it's located. For that reason alone, the residents that live there often stay put. So there's a longer tenure of stay. The average is 14 years in the industry. It's much different than many other classes that are dealing with renters because the turnover is less. So I just love it. I think it's a stable asset. It solves an affordable housing crisis. I think there's a big gap right now between housing cost and rising incomes. So as a result, I believe that it's a very good long-term stable asset to look at. So that's what led me into focusing specifically on that.
Yeah, no, that's pretty interesting because I wasn't sure exactly what the mobile home parks really entailed and why
Yeah,
that would be attractive. But you just nailed it. And then the private lending, I'm still not super clear on. I might have you clarify that in a bit.
sure.
Um, but you know how. I think a lot of founders they're comfortable taking risk in their own business, right? But they're going to be more cautious elsewhere. And so I'd assume you find it a challenge sometimes to explain this to them and build that relationship with the people I'd assume you consider your clients. So how do you go about building a relationship with your clients and measuring your success with them?
You're completely right. It is very hard to get your foot in the door. And what I mean by that is just mentally, there's normally you have your guard up for letting somebody else take control, especially if
Yeah.
you're an entrepreneur. It was the single hardest thing for me, and how I got into this business I was an investor first, and I still do. I'm an investor, and that's what my primary focus is. But it was very difficult for me to hand over my money because before I'd gotten into real estate while I was running my business. So I would take all the funds from that I didn't need to live, and I would then apply them to real estate. And this was starting back in 2012 was the first acquisition, and then 2014, 15, 16. I kept one a year on average because I didn't have the time to do any more. I was very involved as an owner operator in my business, but that got me in the door. But this was a different scenario because I was actively managing and running all of those rentals as well. When I discovered passive income, I thought, well, wow, I can actually get people that are doing this for their full time job. For me, it wasn't a full time job. Mine was running my company. We had 95 people that on average, sometimes we'd hover around 100. It was a busy operation, and all of my effort went there. So when I finally sold, that was the next path because I sold for specific emotional reasons. I had young children, I
Mm,
was burnt out, and you start to think about if I yes, I can go do all these real estate acquisitions myself, but a couple of things happen. A, you run out of money, personal money to keep putting down payments on these properties. And secondly, it's difficult to scale. So that's why there's a power in partnerships and letting people get involved that do this for a living, and they can concentrate on it all day long so that you as the investor don't have to.
yeah, this is fascinating stuff. It's such a different conversation than we usually have.
Yeah.
Loving every minute of it. I think we only have, unfortunately, time for one more question in the
Okay.
interview segment. So for owners listening today that need to maybe take this first step, and I'm not even talking about real estate. I'm talking about uh, passive income, and are thinking about this, and they need to start learning. If they haven't taken the first step, what would it be? What would you tell them to do first?
I would have them look at their reserves and their checking account and think about, is this earning me any money, and are there other ways to deploy this safely? So at the very root of it, start there. And I'm not saying into real estate. You could, if you have the means to put it into a money market account, just something to earn money or interest on the money that's sitting there. Because if you don't do it, the bank is already doing it. So while you sit in your big bank checking account earning 0%, they're lending your money out and they're making good returns on it. But it's your money. So why don't you do it? So I just say start thinking about this a little bit differently so that you can realize these small incremental changes will really add up if you're taking steps in the right direction, because every penny counts. So that's my advice.
Awesome. All right. That was awesome, Ian. Thank you. Let's hit the segments. All right, everybody, it is time for Does It Hold Water, my favorite segment. This is when I ask my guests to be our resident expert witness for the day. I read them a quote, a piece of thought leadership. They have no idea what I'm going to ask them, but it does kind of delve into their area of expertise. You ready?
I'm ready.
All right. Today, your quote comes from Adam Smith in The Wealth of Nations. And in Wealth of Nations, he said, "Every man is rich or poor according to the degree in which he can afford to enjoy the necessities, conveniences, and amusements of human life."
First thing that comes to mind is I don't believe he's talking about money. And a lot of people define success by money because it's nominal and it's something that we can stack against the next person. But what I'm involved with in the group of people that come and invest with us, you ask them what their motivation is, and it's usually not money. So they want the freedom and the life that comes along with it so
Hmm.
that they can be on the beach having a pina colada or a beer while somebody else is working hard, changing out a tenant. And so the more and more people that I talk to that are successful, that definition changes. And I think there's stair steps to get there. I believe that up to a certain income threshold, money is the motivator because it's crucial to have it and it's your lifeline. But once you cross that and get into the comfort zone and then realize how to make your money work for you in other avenues that's not occupying your time, then I think you've unlocked the next level to really feel like you're free and successful.
Yeah, I thought this was a real good one for you because I did see a couple of quotes out there on your LinkedIn page about just this and getting that freedom and that um, I don't think it's a better word for it than freedom because you worked in that world where you were running a business. I mean, dry cleaning is not easy. That is a
No,
lot of hard work. I can't even imagine actually doing the work to actually, press and do this cleats and the getting the shirt just right and the pant like it's a lot of work and it's hot and wow,
hot, very labor intensive,
labor
small
intensive.
margins. Yeah.
And it talk about sweat equity. I mean, like
Yeah. Yeah.
like literally. So no, I thought that would be a really interesting one for you.
I'll share. You say sweat equity. I have to share this because I was in
Yeah.
the dry cleaning industry. With my first week on the job, I was 21 years old, and I needed to make sure that I gained the respect of our cleaning facility and all the people that were in there pressing the clothing. And I was 21, and I felt like I was relatively fit, and it was hot. It was summertime. By the end of that week, I pressed all day long. My body, my back was in pain. Just as a 21-year-old, I had a heat rash covering my entire body, and I said I never want to press a pair of pants again. But it taught me everything I knew, and it helped me gain the respect of the staff at a young age because of I was 21 years old. I didn't have any business skills, so that was my sweat equity from day one. Started with a heat rash. Yeah.
So that's oh man, that is great. That is yeah, literally and figuratively sweat equity. Awesome stuff. Great one. Let's hit chip shots. All right, everybody, it is time for chip shots. This is my segment. It is the kind of shorter form questions, more personal, but still yet professional questions. I ask my guests a little shorter form. We go with 3 or 4, time permitting, and we always start with the book question. Ian, can you give us one book that has influenced you personally, professionally, that you will recommend to the audience?
You've probably heard this one a lot, but I love Rich Dad Poor Dad. I think there's really good principles there. I grew up in a divorced household, and so I could resonate with, and it wasn't two different dads, but
Mm.
different income levels that were happening and the mindset that comes along with it. So I would, if you have not read that book, do it. Even if you're not in real estate, it would really change your perspective on how your money can be working for you.
Yeah. And I have to tell you, for the first time in your customer success history, I have correctly predicted My guest book. I was actually going to write it down. Hold
Oh
on.
no.
I guarantee you, I guarantee, because just this topic is such a fascinating topic. And I did read that book this winter. I had never read it before. And that's one of the reasons when you came to me as a guest, I said, oh, this is like total rich dad, poor
Yeah.
dad stuff. Let's get going on this. And yeah, it was absolutely fascinating and a wonderfully eye-opening different way to look at wealth and income and cash and the income statement and assets and liabilities, right? So if no one's read it, he most people will consider your house an asset, but he doesn't because it costs you money, right? Is
Yeah.
you own an asset on the book as far as real accounting, but to him, this house cost me mortgage, insurance, heat, get right. So that's money going out the door. And so the way he looks at the world is it causing you money out or is it giving you money in?
It's
And
also not a boring finance book. It's simplified to where it's a very easy to digest read. And so
mm,
I appreciate that as well, because even if you're not interested in that style of literature or reading, it's easy to grasp and take away something from every chapter.
yeah, yeah, and it is very fascinating with the two dads. Now, the second dad wasn't his dad; it was his best friend's dad, kind of thing. But regardless, it was just absolutely fascinating. So great stuff, awesome. Thank you for that.
Mm.
So the leader questions. Yeah, I have nowhere now. This I have no guess where you're going
You
with
won't
this
guess
one.
this one.
All right, if you could spend a day shadowing a current leader, or professional in any industry, who would it be, and what would you hope to learn?
There's someone that I've paid close attention to their journey the last couple of years. His name is Sharon Srivatsa. He was in the real estate industry, had built and exited companies very successfully, and now he's part of Alex and Layla Hormozy's acquisition.com. So, a lot of very good tactical content online. I check into his podcast to give me motivation and to get ideas about how I should be running my business. So, he's got a wealth of information to help people in whatever they're doing.
It's whatever you're doing. It's not specific to investing or real estate, or
I
is
would say that it's whatever you're doing in running your operation. It probably leans towards real estate and investing, but the investment piece speaks to everybody. So sometimes real estate is the vehicle that gets them there, but the destination is the income that can come from it. So,
hmm.
yeah, Sharon Srivatsa.
Shavan Savasa. I've never heard of him, but interesting. Another one for me to look up. Awesome. Great. Good
Yeah.
stuff. All right. So if you've watched this show, you know I'm going to ask you this one. This is right up your alley. Is there a particular experience or failure early in your career that taught you a valuable lesson that you still use today?
We talk about, we didn't discuss any failures today, so I'll share something from the investing side.
Sure.
Uh, Passive investing is difficult. It requires a lot of trust. And we talked earlier about really diving into figuring out who you're doing business with.
Mm.
One of my very first investments was a flop, and I didn't know what questions to ask, how to vet these operators properly, and paid an expensive lesson. So myself and probably 100 or more other investors were all duped, and everyone will lose their money that was invested into that deal. Now, the valuable learning lesson from this was I wasn't in the business of raising capital, and I think that lesson alone taught me everything I need to know moving forward to do everything I can to never let that happen again. And so now, as the more you spend time in the industry and learn exactly how it works, the easier you could read between the lines to find out what you're being presented with, whether it's accurate or not. So, yeah, again, that comes down to the trust component, but it was an
Mm.
expensive lesson. I'm glad it happened to me. I'm very glad that I wasn't in the business of raising capital at the time, and I think it sets me up for a foundation for how I view things moving forward.
Right. No, certainly, because you've been burned and you're not going to let that happen again.
Yeah, yeah. No,
Yeah.
nobody wants that.
Yeah. No,
Yeah.
interesting. Great one. All right. One last one. One question you always ask customers or clients that never fails to reveal something new.
I would usually ask somebody what a successful investment looks like to them. And you'd be surprised by the answer. It's one of those silly questions that you feel is from some textbook sales group,
Yeah.
but
Or a
what you're
bad
finding
podcast.
out is, yeah, you want to know what the person looks like or how they view their lens of investing. So sometimes the answer is money. Often it's not. Often it's just, I got in and out, or it was easy, or this one is good because I never heard about it. So it lets me understand exactly what type of person they are and if they're a good fit for what I do and, a good fit for partnership. Because I do view every passive investor, we call them LPs or limited partners in the
Yeah.
industry. I view them as partners. I mean, we're communicating monthly or quarterly on every single asset that we have out there. What we're doing, how their distributions look. So you're connecting with these people year over year, and that partnership's important to have.
Yeah. No, awesome. That's an interesting one and a very unique perspective. I like that question. I haven't asked it enough. That might go back into the starting rotation. We'll
There you
see.
go.
All right, Ian, great job. Ian Noble, let everybody know where they can find you.
So, for the listeners of this show, I created a passive investing cheat sheet. If anything that I said sounds interesting to you, it's a really good guide. It's something I wish I would have had 5 years before I had started in the space. So, we'll leave the download link in the notes.
Yep.
And other than that, runsteadyinvestments.com.
All right. Ian Noble, great guest. Thank you, my man. This is a great episode. Very different, very fresh perspective, and very important stuff. Great to get everybody's mind thinking in that direction. So thank you so much for being here.
Thanks for having me on.
You're quite welcome. Thank you all for watching Your Customer Success. I will be back with more CX leaders, customer success leaders, and a few more tricks up my sleeve. I tell you, I have a few tricks up my sleeve at the end of every show. This was one of those tricks up my sleeve. Great job, Ian. Thank you. Bye,
Thanks
folks.
again.
That's a wrap. Thank you so much for tuning in today. We hope you found something insightful that will enhance your experiences and drive your success. If you enjoyed the episode, please leave a review and share your thoughts to help us improve the show. Don't forget to head on over to maracxhub.com for more ways to connect with me and learn more about experience management. Until next time, I'm Gary Mara, working hard for your customer and your success.